Thank you, Peter. It's my pleasure to be here this morning. I'm humbled to be on the agenda with the speakers that you have, and one of the things I've quickly picked up is that there's a real opportunity for companies like GE and the team that I have who work on forecasting to do a better job connecting with the academic teams and the research capability that's out there. And I think you'll see some of those opportunities as I go through my presentation. I also have a lot of experience on the forecasting extreme event side. We used to own a reinsurance business, and even just coming here and seeing that there's a meteorologist on the agenda and you're going to talk about extreme events gave me the jitters. I was the happiest man in the world when we sold that business. A little overview about GE. Some of you are familiar with it. We've got a number of infrastructure businesses. Our largest business is our energy business. It's about $40 billion of revenue. It's 40% of our earnings. We make gas turbines that create power generation. We've got a huge wind turbine business. We have a large oil and gas business where we sell heavy equipment that compresses and distributes oil and gas products. We've got a water business that's a couple $1 billion that's growing and hopefully more important in the future. We got a lot of technology in our technology infrastructure business, also about 40% of the company. We're a $17 billion healthcare business. We make a lot of technical equipment, CAT scans, MRs, X-ray, ultrasound, a lot of healthcare IT, and we're in life sciences and biosciences. We have a huge aviation business. We're number one in the world in making aircraft engines, and that has a tremendous install base and a great service business. And we also have a large locomotive business where we make diesel locomotives and provide services, and also all the services around the railroad management we provide. We have a significant financial service business, probably about $600 billion of assets. Not such a big business in terms of revenue. When after the financial crisis, the earnings have collapsed, which have been the same thing everyone else has dealt with in financial services, and that's created opportunities for us. Actually, having a smaller financial service business enabled us to change the portfolio in a positive way coming out of this crisis. We own NBC. We're in the process of selling 51% of NBC to Comcast, and we'll own 49%, and over the next 7 years after the deal closes, we'll exit, and we'll take that capital and we'll put it back into our infrastructure businesses. And we also have an appliance and a lighting business that probably some of you are familiar with that is a legacy part of the company, but not really as strategically important to us and not a place we're allocating a lot of new capital. So our business model is to fundamentally invest in technology so that we can win these orders for large equipment that builds an install base, and then we'd like to provide services and aftermarket services to our customers to be able to maintain and provide productivity and guaranteed operating results for our customers. And that service business, that aftermarket, is a higher margin, higher profitability, higher cash-on-cash return. And overall, when you combine it, it's sort of like the razors and blades in a Gillette business. For us, if we can sell an aircraft engine, we don't make a lot of money selling the aircraft engine, but over the next 35 years, we make a ton of money providing the spare parts to that engine. And so this is our fundamental business strategy. We're $157 billion of revenue. About 55% of our revenue is outside the U.S. We're a very global company, 300,000 employees, make about $10, $11 billion in net income right now, and have about $16 billion of cash flow. So it's a large, complex global enterprise. And I thought this morning, based on discussions with Peter, I'd cover a little bit about the environment from a preparer's perspective, some of the things we've had to deal with, and the changes that have been put in place over the last 10 years around disclosure and transparency and what we provide information to the investment community. I spend the bulk of the time talking about how we prepare our forecasts and the infrastructure that I'm fortunate to have to be able to present that material to the leadership team and summarize for the board of directors. And then a little bit about how we communicate with investors and analysts and some of the challenges that we face in that world. So when I started as the CFO, it was a different world in terms of what information analysts and investors got from a company. Our Qs were 17 pages of financial information. Our K was 77 pages. It was fondly referred to as the good old days when, from an earnings perspective for a company like ours on a Thursday night, we'd put out a press release, and on a Friday morning, the investor relations team would just call the biggest investor first. There were no conference calls. There was no disclosure about the business results. It was 2 or 3 page press release. There wasn't really a balance sheet. There was an income statement. At the time, we had basically 2 big meetings with investors a year. We had a strategy meeting in the spring. We still do that. We have an outlook meeting in the fall where the CEO would talk to sell-side and buy-side analysts for a couple hours. And we issued narrow ranges of guidance. There's a perception that a company like GE never misses a quarter. I think the actual results lag a little bit. For my 12 years, I've missed a lot of quarters. My predecessor had an amazing track record, though, and I think it's partly because the world has changed. If you go back to the end of the 90s, the tech bubble collapsed. We had the problems in the world where there were terrible accounting controllership, governance issues associated with failures like Enron and WorldCom. We ended up with legislation and changes in what was required to be communicated. I think fantastic, actually. Reg FD, I think, is absolutely necessary. I think Sarbanes-Oxley has an awful lot of bureaucracy in it, but there's some fundamental things in there that are really important. And the most important for me is that the CEO and the CFO have to sign and certify that everything that's in those financial statements should be in there, and everything that should be in there is included. And I think those are just fundamental things that really do improve how companies report and how companies present their financials and how they think about preparing them. But that change has dramatically changed our disclosure. Today, a Q is 90 pages of financial disclosure. It is dense. It is hard to get through. We spend a ton of time preparing it. The K is more than 2.5 times. We do 30 events a year with investors, and today everything is available on the web. We don't have a private meeting. We'll have a webcast. We'll put the charts on the web, and we'll replay the webcast over and over for investors. Today we have over 25 hours of GE hosted webcasts online, which I think is a great thing. There's over 1,000 pages at our website for investors describing the performance of the company and what we do provide for forward-looking guidance. And we're not giving guidance anymore. So besides selling the reinsurance business, which made me really happy, getting out of giving EPS guidance made me also very happy. It changes the pressures and the burdens and the things that you think about in terms of how you manage the company to just not be giving EPS guidance. I wish we did it 10 years ago, and every time we studied doing it, we always found reasons why we couldn't. But then when we got into the financial crisis, we absolutely had to, because we had a lack of visibility around our financial earnings. And it's a great thing, and I wish we had done it earlier, as I said. I'll cover more about that in a few pages. So, when I think about forecasting and the difference between what we're trying to do from a forecasting as a company and what analysts are trying to do as a forecasting to determine the valuation of the company are pretty dramatic. Our main objective for forecasting is to make sure that we understand how we think our businesses are going to perform. What type of returns are we going to get for the investments we're going to put in place? What type of growth will we have? What will the margins be? What will the cash flow be? And what will the ultimate return be? And where should we allocate capital based on those opportunities? We have 2 main planning events that we do on an annual basis. In the summer, we do a strategic plan called the Growth Playbook, which is a 3 to 5 year plan. I think of it like a Porter model. We basically ask our business teams to understand and analyze the environment they compete in, what's happening from a competitive perspective, what's happening from a technology perspective, what are suppliers doing, what are the risks that are coming, what about supply and demand and macroeconomic factors that will affect their businesses. We have about 45 profit and loss centers in the company that go through the same process. It's a bottoms-up process. It starts in April, really. In some of the businesses, we bring in outside parties to help us to challenge the assumptions about the industries we operate in, to try and develop multiple scenarios. There's always a base case for us, which we think is the most probable case. But we end up with a scenario which is what's a downside scenario, we end up with an upside scenario, what are things that could go better. throughout these reviews, the business teams have to challenge the assumptions, and at the end of the day, we end up with a 3-year financial model that is a full balance sheet, income statement, and cash flow statement for the company. And we'll summarize that in July, and we'll take that to our board of directors and talk about each of the main businesses. We have 12 separate businesses that we report sub-segment financial reporting on, and we'll go through each of those businesses with the board, and we'll end up with a list of 7 to 10 strategic priorities for the business out of this growth playbook, out of this long-range plan. And then what we'll use coming out of this growth playbook is the financial projections for the 3 years. So in the summer of 2010, we're going to have an 11, 12, and 13 financial projection. The first year of that 3-year plan, 2011, will be the basis for the second planning event, which is our annual budget that we do in the fall. So this exercise, this growth playbook, is just an incredibly complicated, externally focused review to try and determine capital allocation for the company. And we do forecast valuation based on the output of that growth playbook, based on what we think our growth is going to be, our earnings and cash, and our returns. And we allocate capital based on where we think the best opportunities are in that growth playbook. And we also mitigate a lot of risks out of this planning session, because there are things that the teams identify that we have to deal with. It may be extreme competitive pressure, it may be a product shortfall, it may be a regulatory issue, but those are the types of things that we'll basically be able to make sure that the team has a strategic hand around to deal with as we go forward. You know, the second main event in terms of planning is our budget. Technically, we call it a session 2, which doesn't really mean a lot, but every big company has a lot of acronyms and different things that we call events. In the fall, the teams, the finance teams, and the operating teams, again, update based on the actuals we have. We have another 6 months of actuals that we can show how the markets acted over that period. What has our business performance been? What are the outlook going forward? And we'll prepare a detailed budget in the fall. We try and use that first year of the 3-year strategic plan as the basis for that, but we obviously have to update it for anything that we've learned in between. And we'll summarize that and take that to the board, and that'll be the basis for what we use as our annual update with investors and talk in December about our outlook for the next year. So these are the 2 main sessions we have, and along the way, every quarter we just have a tremendous amount of rigor that goes around financial forecasting and planning and analysis. Our financial planning and analysis leaders do a weekly call every week of the quarter and talk about where their business operations are versus what the expectations were. We have a short-range outlook in the middle of every quarter. Our financial teams submit this quarter, next quarter, total year, income statement, balance sheet, and cash flow. And so we kind of have a rolling capability to look at our future performance expectations. And then we use that roll-up as the basis for our discussion when the top 30 or 40 leaders of the company get together at the 3rd month of every quarter and talk about the company performance. Basically, I present all the financials on the company performance, and each of the business leaders talks about their business operation and what are best practices that they have that maybe we could share across the portfolio. But from a financial forecasting perspective, this roll-up is the basis for us to make short-term decisions. We have an operating review with each of our businesses in the 2nd and 3rd month of the quarter, where we'll spend a full day with the CEO and the CFO and their operating leaders and our finance teams, and we'll basically have them present their business operations. If you get the sense, we're a very financially oriented company. It's a discipline that it permeates the place. Every discussion between Jeff Immel, our CEO, and another CEO is around how's their business operating from a financial perspective. It's not it's like the fabric of the company is to make sure we have excellent understanding of where we are in terms of performance and where we need to be. At the end of the quarter, we do a weekly call on Fridays with the CEO and the CFO to see where people are, how are they performing, and then we do, after the quarter, we have a big update with our investor relations team to prepare for our quarterly earnings. So it's just a ton of financial rigor that goes into financial reporting, even in a non-guidance world. It isn't really about meeting guidance. It's about delivering a performance that we expect and need relative to the capital allocation. And just some of the details around that. This is a bottoms-up roll-up. I mean, I don't know how an analyst at Deutsche Bank can sit and look at a company like GE and say, okay, I'm going to develop the future financial model. I mean, basically they're taking Excel and they're putting just assumptions into spreadsheets. They're trying to deal with the information that we provide them on an actual basis, but we have the advantage of actually having people sitting with the business teams. They know what the orders have been. They know what the equipment units are going to be. They know what the spares backlog is. They know what the margin rates are going to be on the contracts that we have that are long-term contracts. They have a pretty good feel for the timing of the volume. I just, I think it's really hard for someone. Maybe it's the complexity of GE, but I think it's hard even in a single product line type of business to be able to get your hands around that if it's got more variables than just something driven by consumer demographics. So this is something that we get the benefit of 3,000 finance professionals out of about 15,000 people who work in finance. We have 3,000 who are connected to this financial planning and analysis process in the company, and they're constantly getting real-time feedback because we're comparing what we thought we were going to do to our actuals all the time, and we're dealing with the changes in the environment in real time and then trying to make adjustments. There are some things we do from a corporate perspective to try and drive consistency. We'll provide exchange rates for people to use on their forward rates off of whatever the actual market forward rates are, so everyone uses consistent assumptions about that. We'll try and use consistent assumptions around commodities and sourcing for people who don't have things that are already contracted forward, so that we have some consistency there. But we'll also have a big debate about some of the basics like oil, which drives an awful lot of the demographics of our businesses, whether it's the cost of oil for our operations or the efficiency of running a gas turbine versus a coal plant based on gas prices, or how profitable the airlines are going to be based on what they have to pay for fuel, whether the oil companies are going to reinvest in the oil and gas business. So oil is one that we have a big debate on across the company, and I don't think we've ever been right from a forecasting perspective. And then the other thing I'd say is that the assumptions are challenged at every step of the process. One of the positive things about the GE culture, from my perspective, is it is one that is very open. Candor is encouraged. Debate is rampant. We look for the opposing point of view. We look for the risk. We look for the thing that's a weakness, and then we debate it, and then we make a decision and we move forward. But we hate surprises, and we hate people not giving us accurate information in a timely manner. And as the CFO, basically, the CEO, Jeff, he'll get the good news immediately. The CEO can't wait to call him and tell him the good news. The CFO, I get all the bad news, and I get that immediately as well. And so information flows in this company immediately. If there's something that's different than what people expected in any material way, it comes up immediately through the system, and then we figure out, okay, now what do we do to deal with it? And I'll cover that in a minute. So when you look at the calendar and all of the financial processes that we have in this place, it is just a constant rhythm of we do a lot of forecasting, we do a lot of planning, and then we do a lot of analysis of actuals and look again back at how we perform versus what we thought, and what did we learn about the company because of that, and what do we need to do differently going forward. And a lot of feedback and just a tremendous amount of communication, and all of it flows externally with our actual reporting. So how do we deal with the marketplace? How do we deal with the analysts and investors? Basically, you know how the investment community, the sell-side analysts, basically do their own study of the industry. They have their own view of what competitors are going to do. They get all the information from other companies about how they're going to perform in our industry segments. They have our view, which is our outlook, our framework, where we provide forward-looking information about how we're going to perform. They have all of the actuals and the historic data. And basically, they develop their model, and then that gets aggregated in some way into first call, which I find insane that you end up with a point estimate on revenue. I'm going to go through it. Next Friday's our earnings day. CNBC will put out a press release. We'll have our results, and CNBC is going to make some pronouncement that a company made or missed some revenue estimate. I find nonsense. We have about 15 analysts who cover us. There's probably about 6 or 7 who actually put a revenue number in on a quarterly basis, and then that becomes, from a press perspective, sort of the benchmark of whether someone performed or didn't perform, and creates the volatility which the trading world loves. It's completely nuts, and it's so short term that I try and ignore it and not deal with it. But the process and the system around this is created to encourage volatility in my mind. I don't think any long-term fundamental investor gives a hoot about what we do on an earnings call unless it's a real disaster. They're really looking at longer-term trends, but the amount of trading that happens in a company's stock that's not related to long-term investors is probably 40 or 50% on an average day. And around an earnings period, it's probably higher for the 2-week period before and after earnings. So the volatility is encouraged through this mechanism where there's a precision and an artificial precision around how a company's going to perform. And of course, in a company that gives guidance and then you're trying to react to guidance, we encourage it and we participate as well. But I think you got to somehow get past all that noise if you're really trying to do anything around fundamental analysis of a corporation. So we live in this community. Even though we're not giving guidance, we're measured against some consensus estimate. Even though we can't call up an analyst and say your model's off and here's why, or you're missing this or missing that. I mean, we try and communicate as generally and as broadly as we can, but we're subject to oversight and aggregation of things that really create volatility without us having any say in it. It's really somewhat frustrating. A little bit about guidance, which when I got the job in '98, we were giving a lot of guidance, and by the early 90s, we were giving 150 guidance points, including quarterly EPS in very narrow ranges. I mean, like 3-cent ranges, which would be plus or minus $100 million off our estimate. It really too narrow, hard to manage, very frustrating in terms of trying to keep track of all that and then actually provide explanations for why you missed 6 of the 150 guidance points and what does that mean. And I don't know how we got there. I guess people really demanded more information and we provided it. But it was a crazy way to operate a company if you're really talking about investing for any type of medium-term or long-term shareholder value accretion. In the 2000s, we had backed off all of the data points. We still were given a lot of guidance. We're still giving annual guidance, and we tried to broaden the ranges, and we tried to not get into nothing below a segment, so we would have enough aggregation that could deal with volatility. And when a company gives guidance, I mean, we're actually, what we do is we take all that forecasting that we've done, that's our operating plan, and we would tell Wall Street, here's what our operating manager is going to be measured on. Now the reality is there's so much volatility and uncertainty, and things are going to happen that are different than what you forecast, that if the reaction was, well, now what are you doing about it, and how do you reallocate resources to react to these different things that may be positive or negative, that'd be one thing. But instead, it's like you missed your guidance. Well, that's the reality of dealing in a world with so much uncertainty and so many variables and so much variability. So I think today we're given a lot of leading indicators. We're giving a tremendous amount of actual data. Everything that we do in the company from an actual perspective is out there. But again, as you all know, that's historic. And what do you need to do to turn that into a forecast is the challenge. And then we're giving framework information about how we think we're going to operate in the future, including a lot of operating metrics without getting into EPS metrics. And I think it's a better place to be, but it's still a real challenge. We have a lot of transparency, and we have a lot of access to leadership. I spend time at many of the investment banks conferences just to give an overview of the company and to talk openly about it. The quarterly earnings calls 4 times a year provide a tremendous amount of information. In the spring, we will do a long-term strategic conference called the Electrical Products Group Conference, where we'll give a tremendous amount of forward-looking information around operation metrics without EPS specific guidance. And then in the fall, we'll give an overview, a framework, and I'll show you a few examples of how we're trying to communicate in a non-guidance world. This is from December of 2009, and when you're not giving guidance, and investors, a lot of analysts want guidance, what do you give them? We call it a framework. Basically, all it does is it talks about general trends relative to actual historical performance without giving any EPS data. We said our industrial businesses, which are all those infrastructure businesses in 2010, will be about flat. I don't know what that means to you, whether it's plus or minus 3%, plus or minus 5%, plus or minus 10%. To me, what it means is I'm not giving EPS guidance, and I love it. We try and give some indicators. We got a lot of new products. We've got a good services business. 70% of our profitability in our industrial businesses comes from services, which even in the recession continue to grow. We give a forecast about the number of units. We told them how many commercial engines we're going to ship, how many military engines we're going to ship, how many gas turbines we're going to ship, how many wind turbines we think we're going to ship. So we provide the foundation for our own internal plans without translating it into EPS, which I think is a better way to go. Media, we said would be down. There's some positives, but when we broadcast the Olympics, we lose money in the quarter we broadcast them. And we told them we'd lose $250 to $300 million. So we give a range and talk about it. Capital finance, about flat. For those of you who are forecasting in the financial services world, good luck. It's really hard, and the volatility and obviously the amount of losses that financial companies have sustained over the last couple of years has created a real challenge here. This is the fundamental reason we stopped giving guidance. We were unable to predict within any band that I felt comfortable with what the performance was going to be based on unknowable events in parts of our portfolio. Corporate, we can pretty much estimate our costs. And then so we sort of lay out this framework. We give them a range on cash flow, and it's sort of like we're in Guidance Anonymous zone. We're going to counseling about how to not run a company giving guidance after you've been giving guidance for 20 years, and try and give accurate and useful information so that people can forecast without getting tied down in EPS ranges that really don't do anything for anybody. Here's another example. This is one of our charts that basically people want to know, what do we think about the next couple of years, given that we've had a real reset in financial services and we will have a rebound in financial services. I don't know what 2 pluses means versus 3 pluses. People get out the ruler and measure the bar, and they take our EPS and they actually do a calculation of what we think it is. Things are going to be better by 2012. There's no doubt about it for the company. And what we try and articulate are what are the drivers of that. We're experiencing $12 billion of losses in our financial service business, losses and impairments in 2009 and 2010. A normal year with our credit mix would be about $4 billion. And so sometime between 2010 and 2012, we're going to be back to a more normal loss year. That is going to just not booking those losses again, which good news is you only book a loss once. We'll give a rebound to our financial services earnings. Our industrial earnings, I think we try and talk to people about what's the mix of our services. About $35 billion of our revenue are in high margin services that are a little more stable. They're not connected to an order flow based on supply and demand. It's how people are using our equipment. And if planes are flying, we're making money. And so we talk about our service business and what do we think the revenue is going to do, and they have to predict whether the revenue will grow based on the growth of our install base and based on how companies are using our products. We talk about our backlogs. We show them what our equipment backlogs are. We have pretty good historical relationships between what's in backlog at a certain point in time and what will convert into revenue in a certain point in time. So I think they're reasonably predictable there. And then we also have a significant amount of cash. So we're trying to give forward-looking information and describe how we feel without getting boxed into guidance, and we'll see how it goes. I've had a lot of quarters where we missed in a given guidance world. We'll see what we do in a non-guidance world. I thought Peter and I were debating some of the things that companies have to deal with around communication and forecasting, and here's a few of the challenges that really we have to work through. Number one is what do you do when your internal results are different than what you've given as guidance or the external expectations? And I've had a number of events like that. I mean, post 9/11, we have a huge business in aviation. We insured some of the planes that hit the buildings in the World Trade Center. We insured some of the buildings in our reinsurance business. I mean, it completely was a change to our business model. What do? You have an analyst meeting and you talk about what your fundamentals are, and you have to throw your guidance out the window. And so when you have an event like that, you have to just schedule something and communicate with investors to the best of your ability. In the fourth quarter of 2002, our employers reinsurance business, which did try and forecast and price for and insure extreme events, I couldn't even watch the Weather Channel. When the hurricanes are rolling through, it was just impossible. When our team told us in about an 18-month period that they had 2 1-in-100-year events that were affecting their results, we said, I think your models are really wrong. They couldn't price for it. They couldn't predict it. I tell you, whatever research you're doing on that, I hope the reinsurance business takes every bit you have and applies it, because we couldn't get it. And that volatility constantly made us miss. In the first quarter of last year, we had to pre-announce. We weren't going to achieve our results, and what do? You pre-announce. So when you have a disconnect between your internal expectations, what you've communicated externally, you've got to be transparent about it. You got to get the information out there as soon as you can, and you got to just deal with the implications of that. The second thing, I think it's really, I don't know what the percentages are. I think it's probably 50-60% of our investors and analysts want us to give some form of guidance, more than we're giving today. They're frustrated. We're a large, complex, global enterprise, and in some ways they don't have the time or the resources to do the work that would be required to really dig in and provide good analytics and forecasts around something as complex as GE, and they just like us to tell them the answer. I think we won't go back to that. I think giving EPS guidance was really artificial in so many ways, and created additional liability that isn't worth it. But I'm just saying that investors really, they haven't given up asking for guidance. They ask every quarter, when are you going to go back to giving guidance? And I think it's just because it would be easier for them. And I don't think it would be easier for us or necessarily better for the long term of the company. And then the third thing that really was a challenge, and it doesn't affect you so much from a forecasting, but in the period of extreme stress, in the fourth quarter of 2008 through the first quarter of 2009, in a weekly basis, we could be dealing with 3 or 4 rumors. I would come into work in the morning, and I could be dealing with a rumor that I had drawn my bank lines, that we were going to go bankrupt, that we were going to write off $20 billion in some mortgage portfolio. We didn't even have the assets that were being speculated. But the pace of information flow in the marketplace today, and the use of the internet, and the ability to create volatility is extreme. And what we had to do, first of all, we had to be factual about our actual results, but rather than holding a press conference every morning at 10 o'clock to respond to the rumors, we basically went to the web, and we have a thing that we developed called gereports.com. It's a separate website, and we can put up a response to a rumor in 2 minutes. We just pop up, here's some facts about the business. Every day we provide information and communication about the company. It's really it's a proactive communication tool about the company today. But in times of stress, it was a reactive and a way for us to try and post our story without providing, having to set up an analyst meeting and do a webcast. So it was really an incredible period. So, for us on the communication side, we basically got to have open and fair and very broad communications about anything that's material that affects the company, and that's what our guiding principle is as we look at communicating with investors. So I hope that you see that there's a tremendous amount of rigor from a company's perspective that goes into our forecasting and planning, and it ultimately is to make sure that we're allocating capital in a way that will increase the value of the company for our investors over time. But it's also all along the way to make sure we're identifying either opportunities that exist that we've got to take advantage of, or risks that exist that we've got to mitigate in some way. And that constant flow of communication and feedback loop and challenging of the assumptions is essential. I don't know whether we will give more forward-looking information to help people to do a better job of their forecasting than we're giving today, but we are going to continue to commit to give an incredible amount of actual information, and then however that gets extrapolated, we're all for it. But in some ways, I take my computer with me to China, and the security team says, geez, you know, the Chinese are going to scan that thing and steal everything from you. And I said, what are they going to learn from it? Good luck. You know, it's so complex that they can have it. What are they going to do with it? The point is, even with 3,000 people who are full-time jobs helping me to do the forecasting, the amount of change that occurs because of unforeseen events is extreme. And what we have to do is have a good information flow to react to those changes to be able to make sure that we deal with those things in an effective way. And then finally, just from a financial reporting perspective, whatever the, I've told a few of the team here last night and today, we don't really, as a preparer, we don't really care what the accounting rules are. Whatever they are, we've got to comply with them. We've got to have an absolute world-class team of technical talent to be able to provide the information that's required in a compliant way, a thorough way, in an accurate way, in a best practice way. And we have that today, but it isn't so much that we care what it is, it's that we'd like it to be understandable and things that we can present from our financial information without it being an extra exercise that doesn't really add value to how we run the company. But whatever those are, we're GE. We're not allowed to say it's too complicated, or we don't have enough resources, or we can't provide it in that format. Whatever it is, we're gonna hire the people and get the resources, put it in a way that we can make sure we're completely transparent, compliant with whatever's required out there. So Peter, with that, what I'd love to do is open it up, and I'd love to talk about any part of this. And I think the logistics of getting to the mic are challenging. Maybe I could repeat the question. Would that help? Maybe to maybe facilitate. We could try that if you want. But I'd love to talk about any element of this or anything that I didn't cover that you are interested in. Yes, please.
I have a two-part question. First, you talked quite a bit about allocating capital among the different units, and I assume that you have some kind of hurdle rate in mind for whether it makes sense to make the investment. And I'm wondering how that ties into the overall cost of equity capital, or if you try to make a comparison or a tie-in or a reconciliation. And the second part is, with all the forecasting you do you try to, it's related to the first part, do you then try to come up with a stock price or an estimated price at which your stock should be selling? And if it's different from the actual price, what do you do about that?
So first, I have to write it down or I'll forget the second part by the end. The first question is, as we're looking at running the company and doing all the planning and forecasting and allocating capital, what are our hurdle rates and how do we think about the cost of capital as we make those commitments to different businesses? Fair?
Yeah.
So, it's interesting. We don't. Overall, our cost of capital is somewhere around 9 or 10% today. We have a hurdle rate that for significant investments, our objective, and that would be mostly on mergers and acquisitions, we'd like to get a pro forma on an investment that requires a significant amount of capital to close to a 15% cash-on-cash return by year 5. That is an extremely hard hurdle in terms of getting a return off of M&A capital. With the price multiples on EBITDA today and the premiums you put. So it's aspirational, it's directional. If we've got something that's extremely strategic, when we did Universal, the pro forma was 13%. It was really important. We thought it was a changing event for us in changing the mix of the business model of NBC, and we went forward. We've actually exceeded that pro forma. We've had some pro formas that we put together we thought were going to be in the high teens, and they've been in the low teens. We basically have done a look back of our acquisitions over the last 10 years, and we're probably in the 12%, 13% range on 5 years cash on cash. and that's extremely successful versus what other companies have been able to achieve in inorganic growth capital. On organic growth capital, so in the normal budgeting process for a business, take aircraft engines. We're in the aircraft engines business. We are committed to being a leading player there. We don't take the team and make them give us the hurdle rate or the NPV of every single one of their plant and equipment projects. I mean, to build the next jet engine, we're right now finalizing and finishing the manufacturing of the first version of the GEnx engine, which goes on the Boeing 787 plane. That sucker's a 20-year cash flow break even, okay, to develop an aircraft engine. We're not messing around. We look at the hurdle rates, we look at the NPVs. We're in the business. We want to do it as efficiently as we can, but it's such a fundamental part of our company that we wouldn't not develop the next engine to continue to build out that business. Now, over time, you're going to get a tremendous return once you invest that capital because you're going to be dealing with the spare parts flow. 20 years ago, our predecessors developed the GE90 engine. Today, that engine is going into its early service phases, and it's providing us a tremendous amount of cash flow. The 15-year period in between was not a great return period, but it's a fundamental part of the business. So we don't sit and debate the hurdle rate on an individual P&E project. And at a corporate level, basically, we just cut off capital allocation for the business to do their own plant and equipment at some amount relative to their depreciation based on what they say their growth rates are going to be. And then we adjust it. I mean, if you look today at our appliance business, it's a low growth business. It's a low return business. It's not a business that we're going to go buy Maytag when it came available. That's got maybe a 0.7, a 0.8 to depreciation reinvestment rate. Something like our energy business is 1.3, 1.4 times reinvestment rate because it's a place that's got the best growth characteristics in the company. So we don't spend a lot of time business by business really breaking down the cost of capital. Everybody is measured on the return on capital of their business, the return on capital employed, and obviously in the 3-year strategic plan, people put together a plan that show how they're going to improve that, and then we measure against it. But that's how we do basically hurdle rates. The second part of the question was, what do you do in that strategic plan? Do you actually develop a estimate of the stock price? Are there some other parts to that, or?
Yeah, no, and so in order to do that, you have to have a cost of capital
Yeah.
in mind, and so it would relate to the first part. But then once you get the stock price, if it differs from the price that your stock is actually trading at, what do you do about that, if anything?
Sure. Well, if you start with the CEO of any company, I would say they mostly would say their stock is undervalued relative to what it should be. When you put that together with a 3-year, 5-year strategic plan, what we try and show the board is that by investing our organic capital or organic growth back in new products and in plant and equipment, what the returns will be. And then separately, we add in what we think the inorganic opportunities are from our free cash flow reinvested back into mergers and acquisitions. And based on the growth rates we think we can achieve, earnings and cash flow, what do we think the valuation should do? So we do forecast that. We don't publish it, but we do have a view. It's always directional for me. It's never precise. It's this ought to be really helpful and good, and this ought to mitigate things that are bad, and if we do this isn't going to be good. But it comes out to numbers. We have ranges and we have forecasts of what we think we'll achieve. I mean, today we're sitting here with a stock that's $18. It's trading at 18 times. Our earnings are depressed. We think we have a view based on what our industrial growth is going to be over the next couple of years and what our G capital growth is going to be or what we think the stock will be. I think analysts also have that view, and directionally things usually are aligned. It's which end of the range are you on, versus directionally are people way off. I think people generally, with all the information we give, have the right view. It's just which end of the range are you on in terms of the lower or the higher end of the growth rates. And we allocate capital that way. I mean, right now, we made a decision that allocating capital to media based on the long-term growth prospects, based on our strategic plans, allocating capital to media, NBC, was less of an opportunity for us than allocating capital into oil and gas and energy and aviation and healthcare. And it was based on our view of the industry, based on our view of how much capital you needed to continue to participate in consolidation and what the returns are going to be. And so we use this as a planning process to make big substantive changes in the portfolio of the company. Hope that's helpful. Yeah. Yes, please. Yeah. Well, the question is, we've made a change, obviously, from going from EPS guidance to not giving EPS guidance, and how has that changed internal processes and behavior and requirements to ask managers to make their targets? I mean, we would like our managers to actually execute and meet the commitments that they made to us. Now, we are completely subject to changes in the marketplace. And our main performance measurement for our business operating teams is, are you performing at the top quartile or higher in your industry segment based on the dynamics of the industry segment that you're dealing with? And so it's, I think we try and make our plans realistic and tailored to the individual businesses' industry dynamics. And then we try and make sure that the team actually executes against those in a high performance way, completely with integrity. So we haven't, all that financial rigor, you could say, okay, in a non-guidance world, why don't you throw all those people out, get rid of it, and just let things happen? We haven't done that. We're trying to make sure that our performance is at the top quartile of our industrial peers and our financial peers in the places where we compete. And that feedback loop we find really useful to identify things that maybe aren't going as the way we thought, or identify things that could be a bigger opportunity. We find that useful, and we continue to all the reporting and all the oversight that we've had, even in a non-guidance world, based on the fact that we want to have that performance achieve results that are above our competitors. So I don't know. I think it's better than an environment where you have a 3-cent range on the second quarter, and people are like, okay, fixated on that. Today we're fixated on, okay, the same thing, your operating plan, here's what you said you were going to do. Are you going to do it, and why are you missing? So we haven't changed internally how we're operating, really, but we don't have that same external hurdle out there that's a little bit artificial. It gives us a lot more flexibility. I mean, one of the things that we've done, last year we did $2 billion of restructuring. We wouldn't have done that in a guidance world. We wouldn't have made those investments for the long-term cost structure of the company when you're sitting here with guidance targets. So it does give you a lot more flexibility. I'll tell you, in the second quarter, third quarter, whatever, if we have an opportunity to change the asset mix in G Capital based on some opportunity that comes available, I'd like to do that. And in a guidance world, you might not think about doing that. In a non-guidance world, we have more flexibility to think about some things that may change your earnings in the short term, but improve your outcomes in the long term. But I think we have more flexibility. That would be the one big change, I'd say, on guidance versus non-guidance.
Is that fair to say that it is primarily on the aggregate level, so on the firm level, that you have the flexibility, more than at the lower levels in the firm?
I would say it's more at the question is that flexibility more at the corporate level than at the business level? We ask the business level to identify those opportunities, but we would definitely be in the discussion about whether they would execute something that's a big change in what their operating plan would be. We would have a discussion about it. I'll go in the back if I could. Yeah, all the way in the back.
Keith, one of the things that we're trying to understand as academics is that as standards are converging globally, it's not clear that implementation of standards actually is uniform. So the question I have for you as a CFO of a big international company, do you observe a lot of variation in the quality of data that comes into you from different jurisdictions, different markets, particularly forecast data? And if you observe that variability, what do you do? What are the major actions that you take to try to ensure that that data has high integrity?
The question is around the variability of the data that we get from our global decentralized operations, and is there variability, and what do you do about it? I haven't seen as much of that. Our financial planning and analysis, our rigor starts with our people. We have the same training program that we run globally in every country in the world. We hire 350 students out of undergraduate programs. We put them through a financial management training program. It's a 2-year program. They all go through the same courses. They take the same tests, whether they're in China or they're in the Middle East or they're in Chicago. We have the same corporate audit staff oversight, 450 auditors who go around and audit the company and provide feedback about how operations are working. They do this, the same auditors who audit in developed countries, audit in developing countries. So I haven't seen a big difference in variability based on geography. The oversight, most of our businesses are headquartered, and the core of the information flow comes out of the United States. We have an oil and gas business that's headquartered in Italy, and we have our healthcare business headquartered in London. But we've got a long history, a long legacy of having oversight over that data and having it go through a standard process that I haven't seen as much of that. About, as I said, half our revenues outside the U.S. is done under IFRS and then converted to U.S. GAAP. We do see variability between IFRS country by country by country, and I'd love to have more standardization of that, but we basically forecast on the equivalent of U.S. GAAP basis. So, does that help?
Yeah, I think so. Yeah.
Okay. Yes, please.
Just a question regarding the building up of internal targets. Presumably there's some temptation or some desire by executives of different operating units to build in some slack, perhaps for compensation reasons or whatever. I'm just wondering to what extent, as CFO, you see it as your role to squeeze out some of that slack, or to some extent, are you trying to balance that with leaving slack so that you meet your targets?
It's a great question. It's the bane of my existence. The question is, with all of the roll-up that we have, what goes on with budgeting and planning in terms of people trying to build in slack and the management team trying to take slack out, and where is the right place? I mean, it's been the subject of just tons of discussion. It's an incredible waste of time negotiating internally about what your performance is going to be. Our leaders want to get the best performance we can out of the businesses. We expect that top quartile performance, and we encourage in the dialogue and the budget reviews that, why would this be less than that? Why would this be less than world class? You have these factors that are in place. They seem to be all positive. And you got to deal with these risks. But I would say that at the end of the planning process, our bias, if there's a bias in our system, would be towards getting the business performance. If they deliver their operating plan, it's at the high end of the performance that you could expect based on normal variability and problems to go wrong. And so that creates then businesses coming in with a little bit of a lower estimate, and the dialogue ends up stretching it up a bit. We've had so many cultural iterations. Under Jack Welch, there was his whole idea was throw the budgets out. It's a waste of time. Just have people do stretch, and they'll do great performance. That doesn't really work that well. You don't want people to just lowball everything, and you don't want people to have unrealistic targets. And so we're trying to find that medium ground somehow. What's a plan that if you delivered, you would be considered to have done a great job of execution. Your team would have performed really well in their industry segment against their peers. And it has risk in it that we understand, and it has opportunities that we understand. That's the ultimate goal that we're trying to get to when we go through this budgeting and planning and process. And I think we've learned a lot. I think today we're doing more scenarios than we used to do. Today we're really, just like we deal with broader ranges, we're also dealing with, okay, this is the base case, and it requires excellent execution. And here's the downside, and what's the volatility associated with that, and here's the upside. And I think that's also connected to running the company without guidance allows you to really deal with that in a more realistic way. Does that help? Yes, in the back. Hi.
Yes, I'd like to ask about the risk management process, especially the financial risk management, and how important is it in your forecasting process?
The question's about the risk management process and especially financial risks and how important is it in our forecasting process. You want to do 3 years ago or today? You know, I would say a little different answer to your question. You know, one of the most important things that I've learned and the company's learned over the last couple of years is that the importance of enterprise risk management is far greater than we ever thought. In our financial services business, we have world-class credit risk managers. They are fantastic at credit, at asset exposure, at single point exposure, at aggregations of exposure, at potential probability for loss and the loss given default estimates. Fantastic. Systemic risk, not so good. So I think the big lesson learned around risk is that every company has to be better at acknowledging and dealing with systemic risk. I mean, in some ways, we all got lulled to sleep with all the liquidity and all the growth and the fact that risks that popped up got dealt with in a non-systemic way. And then all of a sudden, everything was systemic, starting with liquidity. So we've had to change how we run the company, not just how we forecast the company. I mean, today we run the company with $60 billion of cash. And you know, I used to run the company with $15 billion of cash. We used to have $90 to $100 billion of short-term commercial paper with $60 billion of bank lines. And we always said, well, you know, if we ever had a problem, we'll sell assets. Well, when you get into a problem, you can't sell the assets. That's part of the problem. So the whole idea of liquidity risk management, I think, is number one, is what people have had to change, and that changes your forecast. Because you got to forecast different. You got your cost of your capital is different because you can't just run with short-term borrowings without a backup line and a cash pool against it. So you've got to start with risk management and then change what does that mean for your forecasting. And I think that every company's done that. I think every company today, if they don't have a different profile and a different policy around liquidity risk management with their enterprise risk leader or their board, then they weren't paying attention the last couple of years. The second thing that from a risk perspective that I think that people need to do better is around asset concentrations, especially in financial services. On an individual credit decision, our team is fantastic, but we allowed some concentrations to be oversized, especially commercial real estate. And we kidded ourselves that our diversification of risk, not having concentration in any single geography, not having any concentration in any single asset class, a split between debt and equity, a split between types of investment, apartments or office or residential, whatever you want to, you know, in commercial, was good enough to be able to withstand severe stress, and it's artificial. And a large asset concentration affected by systemic risk will all be affected in valuation in a similar way. So those are the main things I think from a risk perspective that we've changed around forecasting: liquidity and asset concentrations. Is that okay? Yeah. Yes, hello. I'm sorry. All the way in the back?
I understand that earnings are difficult to forecast, but would you say that your capital allocation is a meaningful summary statistic for relative expected future return over your investment horizon? And first, if so, what's the investment horizon? And second, what's your disclosure policy with respect to its capital allocation?
Well, the question is earnings are difficult to forecast, but could you look at our capital allocation and determine how we're thinking about our cost of capital and what our returns will be, and how do we disclose that? I would say that it varies by business. For example, the aircraft engine example I gave you, you know, the capital allocated there is based on a long-term view of that industry, but the short-term payback of that program that we're doing is not measurable. Right? I mean, if you got a 20-year break-even to cash flow on developing an aircraft engine, you're making a decision that typically you would say your shareholders should tell you not to do, right? Why don't you go invest in something that's got a 3-year payback somewhere? But that's the business we're in, and staying competitive in that business and ultimately having a franchise that lasts for the next 40 years is more important than the third quarter of 2011's earnings associated with that business. So I think it varies by business. We do macro capital allocation, like I gave you an example on the media business, where we've decided that capital would be better spent in our infrastructure businesses. On a business-by-business basis, we absolutely disclose how much internal capital we give them from a plant and equipment perspective, reinvestment, relative to their capital base. And our acquisitions are completely transparent. Every single acquisition we do in the space, you know when we buy something, it's in energy, oil and gas, or aviation. So I think our capital allocation process is pretty transparent. I think our horizon varies based on the long cycle nature of some of these businesses. Aircraft engines the most extreme, but a large gas turbine program might not have a cash flow break even until 10 years. But we're in the large gas turbine business, and we want to stay competitive, and we want to make sure that we have products and services that build that installed base that will give us that annuity on the spares, and we keep our share in that industry space with our customers around the levels that we have it, or improve it if we could. So I think it varies by business based on the cycle, and we're pretty transparent about the capital we allocate based on inorganic capital is very clear, and then organic capital in the plant equipment and in the new product investments that we make is very clear by business.
Well, and is that horizon explicit, and is that horizon something you're willing to disclose?
Well, we talk about it in generalities, but it's not something that we sit and agonize. This is a 3.4-year payback. This is a 4.2-year payback. These are the type, what we basically in this growth playbook, our leaders come in and their marketing and sales and engineering teams have put together out of months of work a proposal about what it is they need to invest in to improve their competitive advantage over the next 3 to 5 years. And that list of priorities based on that domain experience, that team's expertise, we'll challenge how much or whether they've got enough. But the ultimate goal to improve your competitive advantage over the next several years by investing in technology and building the capability to win, at the top quartile performance versus your competitors, that's the goal. And that's something that, I don't think we're not transparent about it. I just don't think we're as precise as maybe you're looking for. We don't sit down and say, geez, healthcare's 2.7 years payback and aircraft engines 5.6 years payback. We don't do that. We say, here's what the healthcare team says they need to do to improve their competitive advantage. Does that fit in our financial profile? It does. Make those investments, and then we really do delegate to the team. You make sure that you're managing those investments. We don't interfere with how they're executing the program to develop the next generation MR. We're really at the corporate level allocating enough capital that they say they need to do that. Yeah. Yes. Hello.
Okay, I want to understand the role of GAAP in your evaluation, the internal evaluation, because you use the word cash on cash several times, and you also mentioned that you evaluate a particular business related to other competitors, in the sense that it should be in the top quartile. So first, my question is, how does GAAP affect your ROA calculations? Because it affects both the numerator and denominator, and also the competitors might be presenting their financial statements in local GAAP. So do you really use cash on cash, or do you use GAAP numbers to calculate ROA? And how do you adjust for the competition?
The question is, how do we benchmark and really measure ourselves against competitors given that there are differences in financial reporting? I can tell you we don't do any adjustments. We take the published financial data and we use it as is and try and, we're basically looking at their reported margins, their reported returns on capital, and we're taking what is coming out of the financial system. So maybe we should be doing more adjustments on that, but honestly, we don't even have anybody trying to do that. We deal with what we get as reported, and most of it comes from investment banks who provide us that benchmark information. So it may be an opportunity. Really, most of our competitors are large international companies, so there's not. I think of them as mostly on GAAP. I think we have some challenges when we deal with Rolls-Royce on what they're reporting for IFRS. That's one that we have to struggle to get. Are we on the same basis? But most of the other companies are. We're taking basically what. We're taking what, maybe it's all flawed, but we're taking what the investment community tells us they're using to make their decisions, right? That's what the investment banks are giving us. Here's the returns for UTX or Siemens or Philips or Rolls-Royce, and how do you compare against those companies? So maybe we should have a different adjustment basis. Maybe the error is the same in all the data. I don't know, but we honestly deal with what we get as reported financials from the investment banks. I'd be interested if there's a really simple, better way to do it. Yes.
Last quarter, you actually have a big tax credit in your capital balance unit help you. And that's actually caused a lot of streets concern about your earnings quality.
Yep.
People can watch your tax credit very closely.
Yep.
And you actually talk about you're frustrated by the short-term volatility versus long-term fundamentals. From a company's point of view, what do you think you can do better? Because that's a fact, the market is very short-sighted. What can you do to convince the long-term investors, long-term fundamental equities improving dramatically? You should not focus on the short-term volatility.
It's a great question, and I'm a student of earnings quality, I guess. And as a CFO, I think I have like 9 lives, and I've used like 6 or 7 of them in my career on different things that we've done, and one of them will probably be around earnings quality. The question is, we have large tax credits in our financial services business, and it's obviously low earnings quality. And how do we deal with investors around should they even care about that versus the long term? It's a great question. In the first quarter of 2009, we're sitting here with Armageddon in the world and questions about the viability of our financial services franchise. And will there even be any profitability? And we made income because we had the benefit of tax credits. It's actually one of the benefits of GE and GE Capital being together. Our GE Financial Services losses can be offset. We file one consolidated return against our GE Industrial earnings, and GE Industrial actually pays GE Capital for those tax losses. So are those tax credits useful, valuable? How should investors think about them? For me, in a time of crisis, getting a tax credit is additional capital. I don't really care about the earnings, but at the end of the day, it was additional capital, and it showed that the business was in a place that it could work its way through the financial stresses we were dealing with. I'd take the hit on short-term earning quality issues versus having that capital. It's real cash. It's real capital. But in the long term, you're absolutely right. I mean, in the long term, our goal is to have sustainable pre-tax earnings and a explainable, sustainable tax rate, and that's the only way you're going to get a real valuation. And I think if you look at GE today and you look at the concerns investors have, probably the number one concern is around our real estate business and what's the embedded loss and what will the losses be and what's the pressure in the portfolio over time. And probably in the top 5, one of them is around earnings quality and taxes. And my goal is that through this strategic plan, we'll get back to a place where GE Capital actually has sustainable pre-tax earnings and a normalized tax rate. And I think we would really benefit if we had international tax reform in the U.S. that gave us a tax system on a territorial basis that was similar to what all the other developed countries in the world do. So I think it's a great question. In the short term, we're willing to live with discussions about earnings quality and lack of sustainability if at the end of the day it made the business stronger and it was real cash and capital. That's a net positive trade-off for us, even though in the long term that isn't something that you get paid for. In the long term, I'd like a sustainable, explainable, consistent tax regime that we can talk about that investors can value.
Just have
Yeah.
one question. GE's, you have the historical high backlog. How important is backlog to your forecast?
Hugely. The question is we have a couple elements of the backlog. We have a backlog for equipment, which is very important, and we have a backlog for services, which is much longer term. Our long-term service equipment contracts are averaging 10 to 12 years. So that services backlog comes in over a much longer period of time. The equipment backlog is critical because we're a longer cycle business. We don't have things that are just so economically sensitive that a short-term consumer pickup and you're going to see a pickup in our results. If people want to put a power plant in, it's a couple-year cycle. They've got to decide they're going to allocate the capital to it. They've got to permit it. you go to a hospital and they want to buy an MR scanner, they're going to put it in the capital budget, they're going to do a plan, they're going to have to do the capital, they're going to do the investments. It's shorter than a power plant, but it's still a longer cycle product. An aircraft engine, you're going to buy your planes over the next 5 years. So it's a longer cycle business. So that equipment backlog is critical to us for multiple reasons. One, what level of orders are coming in? When we get orders on those long cycle equipment units, we get cash. We get progress collections from our customers. So orders not only signal the future health of the business, they give us current cash, and that's really important. And then how will we perform if we don't have that orders backlog? We're not going to be able to basically get to the growth levels we need as we go into the next year and the year after. So equipment backlog is hugely important, and it's something that when we talk about running the company, we're monitoring orders on a very frequent basis, and we're monitoring the margin in those orders, and we're monitoring the cash that comes with those orders. Hugely important to us.
One last question.
Okay, Peter. Yes, please. I don't get a Trevor question? He promised me a question. I'll save one for you, Trevor.
Keith, I wanted to go back for a moment to forecasting risk. And obviously you ask the business leaders to give you their best estimate of what's going to happen in the future.
Yeah.
But do you also ask them to give you kind of the bull scenario, the bear scenario, maybe put a probability or two on some of that? And separately, but relatedly, do you ever ask them to think about, almost out of the box, about tail risk and what they might do in the event of the once in 100 year either storm on the upside or on the downside?
The question is, in our forecasting, how do we ask our business leaders to come in and talk about the case, upside, downside, and how do we think about tail risk? We are asking our business teams to come in with a base case and with scenarios around, first of all, there's a whole set of assumptions that deliver the base case, and then there's clearly things that could be worse and things that could be better. And I would say over the last couple of years, we're pretty good today at doing scenarios. It's a better way to run the place, and it gives us a much better picture of what we have to deal with in terms of volatility. Tail risk, I think we overly simplified things and dismissed tail risk prior to this financial crisis. As a business community, as a leadership team of our company, I think we, for example, in the summer of 2007, we had made a decision to get out of the U.S. mortgage business. We did it in the fourth quarter of 2006, and we sold everything through the first 4 months of 2007. U.S. mortgage business. We shouldn't have got in it. We got in it. We decided to get out. We looked at the market. We're out of the U.S. mortgage business, but we looked at the market and we said, what about commercial real estate? And we actually went and got a study by a third-party consultant, and they gave us a pitch, a presentation, nice little white paper about how liquidity was going to last forever because all the demographic factors in the world, all of the private equity funds that had all this money, all the sovereign wealth funds that had all this money, all the oil money and money flowing into the emerging markets, that liquidity was going to last forever, and it lulled us to sleep about things that we should have connected. And so it wasn't that we weren't trying to think about it, it's that maybe the input signals we took the ones we wanted to hear more than the ones we didn't want to hear. And I think one of the things that we've tried to react to and learn from, in addition to better enterprise risk management, is where are the naysayers and why are they there and what are they saying? And instead of just dismissing it, embrace them and bring them in and talk to them and try and understand what their vulnerability is that they're pointing out as opposed to just dismissing it. They don't know what they're talking about. And I hope we're better at it, but it's not human nature to embrace that, and it's harder. But I think you have to think about tail risk more broadly. You guys are talking about it and writing about it, and it's real, and it's the thing that will dramatically change your business model as opposed to just be a possibility. And for us on tail risk, liquidity is the number one thing for me. Having enough cash on hand at all times to withstand a 2 or 3 standard deviation adverse event is just a necessity. And I think boards are going to require that. I think having more capital is important, but having the cash and the liquidity to prevent the run on the bank is critical. And I think that's how we're thinking about dealing with tail risk is trying to make sure we forecast probabilities and adverse events in the event you get into that tail risk. What could really go wrong and how bad could it be? But the most protective thing I think we can do as a company is to have an extreme amount of liquidity available to deal with that.
I'm not going to give Trevor that question.
Okay.
Thanks for a tremendous start to the conference.
Thank you.
Really appreciate it.
It's a pleasure for me to